Hey everyone, welcome back to the Smash Property Market Update for the month of August. My name's Nick V. I'm the founder and director of the Smash Property Buyers Agency, and every month we bring to you the latest property market information so you can make the right decisions out there for yourself. Now, as always, none of this is financial advice. Please don't base your investment decisions on what you see strictly in this potty. It's really just to give you an idea of areas to look at, things to pay attention to. The format for this month is we're going to look at the high-level property market update across the country, deep dive into the capital cities, and then at the end, we're going to go through some specific areas based on specific budgets. So for this month, we've got areas at $500K, $600K, and $800,000 as well. Now, let's dive straight into this one. If you get some value out of the video, appreciate it if you could like the video and consider subscribing. Now, starting at the high-level overview, if there's a takeaway you get from this, it's this. At the national level, dwelling values rose in the month of July by 0.6%. Now, in dollar terms, that equates to around $5,000 in increased value at the median level. So I like to put that in dollar terms always, just so we can see how much it's actually costing us to wait and sit on the sidelines. So at the median level, prices across the country are sitting at $844,000, which is up almost 4% on where it was once last year. Now, the growth is largely across most of the country, if not all. Darwin is leading the charge at 2.2% in increased value for the month of July, but we've also got Brisbane, Adelaide, and Perth still continuing to show some very strong results when we look at it on an annual basis. In the rental side of things, conditions remain pretty tight, although it looks like it is starting to ease on where it once was based on last year's peak. So we've still got very strong rental conditions. It's starting to sort of flatline a little bit as we go through. Now, inflation, as you guys probably have seen in the news, inflation is starting to ease. Expected rate cuts are still on the cards, with some of the major banks looking or expecting interest rates to drop with another 2 cuts before the end of 2025. Now, if those things happen, rate cuts, that start to come back down, it is going to add so much more fuel to this property market fire that we have going on here. So from an economics point of view, I'm not an economics guy. Like I wouldn't say that I'm an expert at this or anything, but I like to pay attention to it because there's a few drivers and a few factors that I'm going to go through that are really going to dictate where the property market goes and how quickly it gets there. So as I just mentioned, the interest rates, they're currently sitting at 3.85% after 2 earlier cuts this year in 2025. Lots of the big banks are expecting that rate, the cash rate, to fall to 3.35 by December. And with the cash rate futures market pricing in the possibility of even 3.1%. So at the moment, borrowing costs are still higher than pre-2022, but the worst of that conditions is definitely behind us. And like I mentioned, if those rate cuts come in, that is going to basically allow more people into the market. To start with, it is going to allow people that are already in the market a stronger borrowing capacity to buy even more. So it is just going to add more fuel to the fire. Inflation sitting at 2.1%, which is back inside the magical Goldilocks zone for the RBA, between 2 and 3%. And housing supply shortage, one of the key reasons why property in this country has been so, expensive or continuing to grow in value. We're just not building homes quick enough. According to some of the data that I've looked at here, the government's $1.2 million homes by 2029 is already off track, and we're only in 2025, midway through it. So some of the forecasts that we're looking at are showing a 260,000 home shortfall, which is, like I mentioned, one of the biggest drivers that is keeping property prices and rents elevated at the time being. Another component to that fire is migration, which fuels demand, right? So migration remains very, very strong. We've got 340,000 net arrivals last year after a record of 446,000 the year before. So it's important to piece this kind of in context, right? So people come to the country, they migrate here, they generally rent first, right? So that adds pressure to the rental market first. It keeps vacancy rates very, very low. And over the longer term, that fuels demand for both rentals and houses to buy. So it adds fuel in both of those rental and housing markets as well. Now, wages are up. This was actually interesting to me. Wages are up 3.4% annually. So wages have actually, for the first time in a while, outpaced inflation, which gives households an actual pay rise. Unemployment's slightly risen to 4.3%, but by historical standards, that 4.3% is still very, very low. So we've got jobs that are pretty steady. We've got incomes that have actually improved when we factor in inflation. So households are in a stronger position to manage rents and mortgages. So I like to just go through all of those things to kind of paint the scene of where the property market sits as a whole and looking at some of the key drivers behind why prices are where they are at the moment. So let's take a look at the capital city performance. I love this one. Now, this month we've sort of changed some of the format because I wanted to actually piece in the dollar amount or the approximate dollar amount that these housing markets have grown in this time. Now, leading the charge for the month of July was Darwin. Darwin jumped up 2.2% in the month alone, which is about an $11,800 change in the median value in Darwin. And it's important because if you were waiting to get into Darwin, it's just cost you almost 12 grand by waiting. Annually, it's up 8.5%. We've still got the median dwelling value sitting at just under $550,000, which is very, very interesting. Coming in at second place, we've got Perth. Now, Perth has jumped up 0.9% in the month of July, which is just under a $7,500 increase in the month. Annually, annualized, that's up 6.5%, which if you've been following this for a little bit of time, it has slowed down a little bit. The growth is still there, but it's definitely come off the boil from where it was maybe sort of 12, 18 months ago. Median dwelling value in Perth, $831,000. Coming in at third place, tied together, is Brisbane and Adelaide. So Brisbane and Adelaide respectively went up about 6.5 to just under $6,000 in the month. Now, both of them sitting at around 7% annual growth for those capital cities. Brisbane, median dwelling value at $930,000, and Adelaide sitting at just under $844,000. So there's some insane amount of growth in these markets. We've got Canberra. Canberra was up 0.5%. Which is a monthly change of $4,300. Canberra's median dwelling value, the annual growth is only up 0.5%. So a couple of months back, Canberra had hit the bottom of the cycle, it seems, and it is starting to sort of come back up again. Median dwelling value sitting there at $861,000. Then we've got Sydney, up 0.6%, which is a monthly dollar change of $7,300. Median dwelling value in Sydney, 1.2 mil, which is insanity. And Melbourne coming in last at 0.4%, which is up. So it's up $3,200 in the month, and annual growth is only up 0.5% at the median level. Median dwelling values there, it's been outpaced by Brisbane, Adelaide, Perth, even Canberra at this point. My opinion is Melbourne has hit the bottom of the cycle, and I do believe that it will start to rise as we head in, particularly to the latter part of the year, as interest rates come back down, as migration continues to flow. They will tend to flow into Sydney and Melbourne first. So I think it is go time for those of you looking to invest in Melbourne, and you want to, I guess, maybe speculate that Melbourne is the next growth market. I think it is time to do that, which is, I think, the first time I have said that on a potty. Some things to consider with Melbourne. Stamp duty is, Victoria really, stamp duty is considerably higher than some of the other states. Land tax needs to be considered if you are looking to buy in Melbourne. The yields are naturally very, very low. However, when you compare some of the holding costs in Melbourne, for example, the council rates, water rates, insurance in some cases, and even property managers in some other cases can be considerably cheaper than, for example, Queensland. So when we look at those things on balance, the net yields in Melbourne or Victoria versus Queensland are very, very similar depending on the market you go into. but we've also got to look at land tax and stamp on the way in. So just factor those in before you make any specific decisions. I will mention also Hobart is showing up here 0%. Now this is technically correct. It hasn't really moved at the median level, hence why the monthly growth is showing 0%. So it's been pretty stagnant down in Hobart, and actually when you look at it annually, it has actually come back 1.1%. So that's not an error in the data. It really just hasn't moved at all. So let's look at where you can focus on based on your specific budget. Now we'll start with $500,000 budgets. Now this is strictly looking at houses in these particular markets. We've left out townhouses and units because you can obviously get townhouses and units, way cheaper than this. But this is for the investors that are looking for houses. And we'll start with East Bendigo. Now this is obviously in Victoria. The price point is under 500,000 by some margin, depending on what type of asset you're really looking for. Yields are sitting at 4.2%. It's pretty stable in Bendigo. So this will be good for those that kind of want a bit of a balanced strategy to a degree, whilst still kind of swaying and focusing more on the growth aspect. So why is East Bendigo one of the recommendations that I have here? It is a very strong regional hub, and it has been for some time. We've got a good health and education sector there. Vacancy rates are very, very low, in some pockets near zero. And in certain pockets of the city, you can get under 500,000, despite the median level of the city being slightly higher than 500K. So you can definitely still get in there for under 500. You just got to pick the markets. East Bendigo is definitely one to be paying attention to. East Wagga Wagga. This is in New South Wales. You can definitely get something well under 500K. The yields in some of these markets are, 5.5%, even closer to 6%. In my opinion, it is part of an early growth cycle. So, for those that kind of, again, want that balanced strategy, you want a pretty decent yield. You also want a bit of a growth play as well. The reason why Wagga Wagga is definitely flagged for me, we've got very strong defense presence there, very strong education and health anchors in that particular market. It's very affordable. I very much like this area. Very, very strong yields and reasonably low vacancy rates as well, depending on the pocket that you are looking in. One of the other suburbs that's come up, Mitchell Park, Ballarat. This is obviously Victoria as well. It is quite an affordable suburb with virtually no vacancy. We've got very consistent demand and pretty strong cash flow as well. For a property that's under 500K, we're getting yields close to 6%. You've got to be very picky with the asset here to get that type of yield. In terms of its trend, it is a stable market. There has been some growth there, but I believe it will be much like some of the Queensland markets, very much stable moving forward. And yeah, again, for those that want that growth and yield play, I believe those two markets will be quite good as well. I'll also mention, which is not on here, just because we're putting up Victoria here doesn't mean we've abandoned, places like, WA and Queensland. There are still some amazing markets in Queensland that we're still buying in to this day. And there are also some good markets in WA as well for these similar price points. So this is just to give you an idea of maybe some of the newer markets that you might have not yet considered. So under 600,000. Perth is back on my radar, as I was just mentioning. So the Perth Fringe in WA, Baldivis, did I say that correctly? I always butcher that one. Baldivis, however that is, I don't know. Byford, Ellenbrook. In that sort of under 600K bracket, yields around the 4.5% to 5%. It is actually accelerating those particular markets. Perth is up there in terms of its national growth, as you've just seen. The fringe suburbs are still affordable. We've got vacancy rates that are very, very low. We do have some major infrastructure projects going on around that particular area. The rail, freeway upgrades, which is all adding to the demand of those areas as well. Under 600K, the Fraser Coast. Now, Harvey Bay is not going to be anywhere, around the 600K mark, but there are other parts of the Fraser Coast, Maryborough, and a few of the surrounding pockets around there. In my opinion, an early phase of the growth cycle, we've got 4.5% to 5% yields. Very strong migrational flows. It's not too far north of Brisbane and the sunny coast. We've got big healthcare expansion, reasonably affordable market in a very livable part of the country. Make Queensland, this area and other parts of Queensland, still very, very consistent regional performers. You know, a lot of people were shitting on places like Rocky, Bundy, being like, oh, it's had its thing, it's done its thing, it's time to bail. Those markets are very consistent, and I believe they will have sustained growth. They might not have double-digit growth in the next couple of years, but sustained growth that if anyone is in those markets and they just hold, you're going to have a nice amount of equity cushion there to be able to release that equity and go and continue buying in some other markets as well. Bundaberg, one that's been very good for myself and clients that we bought recently. I still think it is a great market for under 600,000, although those days are seemingly becoming very few and far between. But if you can get something, in around the 550, definitely under the 600 mark, I think you're doing well. Yields there are still reasonably strong. It is a market that has had sustained growth. I mean, we've had lots of clients that have made, close to 100 grand, if not over 100 grand in less than 12 months in that market. So yes, it has had a lot of growth. I do believe there is still some more to see in that market. And the reason is it is a very strong regional hub. This is not a, tiny little town. It's got, strong agriculture. It's got, strong tourism, strong health sector, among a few other industries as well. Very, very tight vacancy rates. The supply in Bundaberg was extremely constricted for a very long time and still is to this day. We've got good migration from other parts of the country moving there as well for a couple of reasons. It's affordability, it's livability, plus also the jobs in the area, and the yields there remain very, very strong as well. So love Bundy, love Southeast Queensland all together, and WA, specifically Perth and Perth fringes and the south of the city as well is definitely back on my radar for under 600K. Let's take a look at $800,000 mark and where you can be potentially looking. And Melbourne is on the radar, guys. For a very long time, I was sort of anti-Melbourne, don't buy in Melbourne just yet. I believe the time is now. And there are some suburbs which we'll go through. So West Meadows and surrounds, this is on the northern side of Melbourne. We can get in there for under 800,000, in some cases well under 800,000. The yields, like I mentioned, it's sitting around the 4%, low 4s in some pockets, high 3s in certain others. This area I like because by Melbourne standards, it is quite affordable. We've got very, very strong demand from the airports and logistics corridor. And despite Melbourne not having much growth at the median level, this part of the city has actually had some pretty sustainable growth over the long term as well, which I will expect to continue growing just based on the dynamics of the area. This next one, Keilba. How do you say that one? I don't know. Let me know in the comments below. But this is on the northwestern side of the city. Again, around that sort of 760. Definitely under 800,000. Now the yields here are a little bit lower. So these are the high 3s in terms of rental yield. Now this is an equity play more so than a balanced cash flow growth play. So this is more so, hey, I'm buying in here because I want to get the growth. We've got zero vacancy or near zero. Very close to sunshine, only 15 k's from the CBD, and strong long-term growth. I'm talking in the 6% over time. So this is actually important. Probably a good time to mention. Just because you see an area is flat, it's not doing anything, that doesn't mean that the whole city is not doing anything. Melbourne has had growth in certain pockets. We just, the headlines sort of take it and make it sound like the whole city's gone backwards and it hasn't grown at all. This is why I always say, whilst we're going through these suburbs and it's important to kind of, look at where, you might want to potentially buy, don't ever forget that finding a good deal should trump everything. Right, take Hobart for example. It's had no growth there in the last month, but guarantee you there'll be some great deals down there that if you know what you're looking for, you will be able to make money buying the property and over the long term as well. So just don't ever lose sight of finding a good deal should trump all of these hotspot areas and things like that. So another suburb in Melbourne under 800,000, Alban Vale. English is my second language, guys. So Alban Vale is in the western side of Melbourne. We can get something here for under 800, if not sort of under 700 as well. Yield is the 4% mark. This is a balanced play. You get some reasonably good growth and some decent yield comparatively to the city overall. So we've got affordable entry points, big family demands there, very tight vacancy rates, and it's sort of in that growth corridor, that spillover from St. Albans and Sunshine that sort of spreads out that way. So you sort of have that ripple effect into that part of the city as well. And last on my list for under 800K, Brisbane. Ipswich, I love personally. I've got some vested interests in Ipswich. I have bought for clients in Ipswich. I bought all over Brisbane. I love Queensland. I'm a Queenslander, even though I live in New South Wales for now. Probably going to not for very long, but Queensland, Ipswich LGA. So you can definitely get some very, very good quality assets for under 800,000. In fact, probably considerably well under 800,000. We've got pretty good yields there. At the 800,000 mark, you're probably looking at the low fours, but if we sort of get between the 650 to 750, it might get to 4.5, potentially 5. The growth trend there, this is one of the fastest growing LGAs in Queensland alone. We've got affordable properties there comparative to some other parts of the city. And just I don't know if you've ever been there. I've been there multiple times this year alone. The area is changing rapidly. The demographic, the infrastructure, the jobs in the area. So it's not what it once was, many moons ago. Ipswich is also good. And I'll just throw out another one there. The Strathpine region as well. Not Strathpine region. Oh yeah, Strathpine, but it was also Moreton Bay as a whole. Pretty much anywhere kind of south of the southern part of Kalanga. If you can get something for under 800, although days like that are soon going to be gone. That market is also very good as well. So those are some areas that you can look at. Hopefully you got some little value out of that. If you did, consider giving me a thumbs up. Let me know I've done a good job here. And if you like this kind of property content, consider subscribing to the channel if you haven't already. So look, my kind of wrap up here. Similar to last month, right? We've got some pretty strong fundamentals lining up for investors in investors' favor, right? You've got interest rates the interest rate cycle starting to come back down. You've still got very, very tight supply. You've got increasing demand through migration that's coming through. These are all kind of a little bit scary, to be honest, because no one knows what's going to happen tomorrow. But when you sort of line up all those factors, you're like, where is this going to go? So I'd rather have skin in the game than not. So in my opinion, there are some amazing pockets depending on your budget, right? Like property doesn't have to be, a rich man's game. You don't have to have tons of cash. You can get in sub 500K, right? Like if you've got 50 grand, 60 grand. You can get into the market. Sure, it's not going to be a capital city. Sure, you might have to sacrifice on the type of asset, but you can get in, right? You can get in, and as you've seen, the way that the market moves, you're going to make, if you buy reasonably good, you're going to make something out of it. So I'd rather be in the game than not. Don't ever think that you can't afford it. We've definitely helped some investors on some very reasonable salaries or below average salaries get into the market. So there's areas you can look at for sub 500. There's areas like the Perth's fringe for around the 600s. Some of the regional Queensland markets as well. Melbourne, like I said, I think Melbourne is go time for those that want to have that speculative growth play in the Melbourne market. Just consider those things that I mentioned: land tax, stamp duty on the way in. Watch your holding costs, like calculate those holding costs before you jump in. If you want a bit more of a balance, Brisbane and Queensland as a whole might be a better play for you if that is something that you're looking for. So, I say this all the time because people come and they ask, what's the best market to go into? The best market is the best market for you, right? The best market for me might not be the best market for you, and so on, right? So this is why doing your due diligence beforehand and just kind of breaking it down and going, okay, what do you need as the investor? What are you doing this for, right? It's likely you're going to need some growth, likely you're going to need some equity. So what's the best market I can go into at the budget that I've got that's going to give me the most amount of equity that I can afford to hold? This is where cash flow comes into play, the rental yield. So we need to balance all of those things based on you specifically as the investor. So don't just run into Melbourne because you think Melbourne's going to be the best growth play. It's probably going to be, but can you afford to hold the property there, right? Can you afford to buy into Melbourne and then buy another property in the next 6 to 12 months? Because if you're looking to grow a portfolio, that's what you need to do. So we've got to drill down through all of these things so that you can get the best out of it. If you want help on your journey, you want help drilling down on all of those things, you can find us in the description below. There's options to book a call. You can follow us on social media. We do content like this pretty much every single day. And yeah, if you need help finding and buying the right property for you, that's what we specialize in, and helping people build scalable property portfolios over time. So that's all we have time for this episode and this property market update. I hope you got some value out of that. If you did, appreciate another thumbs up and consider subscribing if you haven't already. Until next time, thank you so much for watching. I'm Nick V. Catch you soon.